Hello, fellow risk takers, and welcome to my worst investment ever. Stories of loss to keep you winning. In our community, we know that to win in investing, you must take risk, but to win big, you've got to reduce it. Ladies and gentlemen, I'm on a mission to help 1 million people reduce risk in their lives. To join me, go to myworstinvestmentever.com and sign up for our free weekly Become a Better Investor newsletter, where I share how to reduce risk and create, grow, and protect your wealth. Fellow risk takers, this is your worst podcast host, Andrew Stotts from A Stotts Academy, and I'm here with featured guest Carter Malloy. Carter, are you ready to join the mission?
Absolutely.
Let me introduce you to the audience. AcreTrader's CEO, Carter Malloy, grew up in Arkansas, farming family, and has had a lifelong passion for agriculture and investing. Before founding AcreTrader, he spent 5 years as part of the founding team of a successful global equity investment firm. Before joining in 2013, Carter was a managing director with Stephens Inc., a large private investment bank, where he was an equity research analyst, a lot what I did in my past. At AcreTrader, Carter has successfully raised over $60 million in Series B funding and grown from 20 employees to 120 employees across the company's two business divisions, which include AcreTrader, the farmland investing platform, and Acres, a land research platform. Carter, take a minute and tell us about the unique value that you are bringing to this wonderful world.
Thanks, Andrew. That's a very personal question to start out. Let's see. So the thing that I care most about, I'm going to put aside my family, which is the always number one. As I think about bringing value to the world, while I'm excited about investing in farmland, I think that bringing value to rural America and rural communities around the world is incredibly important. What I focus on as a manager of a business is helping people to be the best version of themselves. And so helping all of us that I work with and partners throughout our business to try to be more introspective and try to improve ourselves as much as we can so that we can all bring value. So I would hope that the people that I work with bring a lot more value to the world, and I expect that they will bring a lot more value to the world than I will individually. And that's really exciting to think about.
It's interesting because when you think about business, people like come to business, come to the job, deliver, what you got to do, and then go home and all that. And one of the things, about living in Thailand is that you realize that Thais are not motivated by money. Money's important, but what really is motivating for them is to have a working environment with people that they like. And one of the things that I always found a little bit difficult when I first came to Thailand was that at Pepsi, where I worked in Los Angeles before I came here, on the weekends, you'd never spend time with your colleagues. You would just go home and do your thing at night and all that. But in Thailand, it's really important that, you spend some time together. And then they like to do like outings where everybody goes out together. And now I really started to understand that it is about developing personal relationships and how much better life can be and how much better work can be. I'm just curious, when you're talking about like bringing out the best in yourself, how does that manifest in your life and in your business?
I think that for me tends to equate to growth, right? So trying to get better, and of course you're going to fail at that often and constantly, but continuously trying to improve oneself. For me, like what do I like in that personal growth story is I like to learn, and I'm a big researcher, and I also enjoy practicing music and playing music personally outside of work. But both of those are sort of these never-ending journeys that you can go on to try to better yourself and just get a little bit better. If you're working from a low base, as I often am, especially within the world of music, it is really, it's encouraging to get to make some advancements at points.
Yeah. And I think for the listeners out there, it's a great motivation to say, like, what is it that you are committing to improving yourself? And the other part of it is that it's never ending. There's always opportunities to improve. I'll just share a little personal story. Something when people ask in a group, how they say, tell us something surprising about you that nobody knows or something like that. I say, well, I was in jail when I was 14 years old, and I almost killed myself at the age of 17. And then I went through 3 drug rehabs for the whole period of my high school senior year. And then I got clean and sober at the age of 17, and I've been sober for 40 years. And so even though medical or marijuana is pretty hip now in Thailand, you never find me consuming it just because it would set off a maelstrom in my life. But the point is that when I started really focusing on improving myself emotionally, which is really what it was about, rebuilding relationships and emotionally, I can say from the moment that I got sober and started to get clean and really start to see life differently till today at the age of 57 now, I just see that there's just always opportunity to continually improve. So I think it's an inspiration, what you're saying, for all of us, to just say, how do we keep getting better?
Well said.
Um,
Thank you.
Yeah, so I appreciate that. Now, before we get into the big question of the podcast, I really want to understand more about what you're doing. So maybe you could just give us a breakdown of kind of how I, particularly because why should somebody be interested in investing in real estate? I mean, come on, there's a stock market and there's this and that. And, why do I even need to be interested in that? And then how are you providing that, platform and that opportunity for people to get involved?
So the first is the why. In our case, not just real estate, but a rather obscure form of real estate called farmland, right? Land that grows food, fuel, and fiber. And so why get interested in that beyond the fact that it is interesting that we do those things, and it's fun to be part of and fun to support rural communities and fun to support farmers and their growth. From a portfolio standpoint, most folks are familiar with this word diversification. And many folks are familiar with the idea of risk-adjusted returns, right? In the world of farmland, we are not out looking to make big hits, right? We're not out saying you're going to double your money next year. Like this is not a get-rich-quick scheme. In fact, we try to view it as the opposite. We're looking for steady compounding of capital, and as most of the great investors of all time will tell you, that is a really powerful thing, right? The thing is an Einstein quote. It's like, compounding of capital is the 8th wonder of the world. And that is what we're specifically after as a business, is that slow and steady wins the race.
And what would be, let's say, what would be your estimate of what someone would expect in farmland, I don't know, over the next, 10 years? Is that 3%? Is that 8%? Is that 12%? What would you say is where you think the growth can be in that space?
Well, the last 10 or 20 or 30 years has been like low double digits, call it, right?
Yep.
So something similar to the S&P or real estate, the commercial real estate as an example. However, it has shown far less volatility than those asset classes. So it has not moved up and down quite as much, just been a little more stable in how it's produced those returns. History is not necessarily how the future will play out, right? We always make sure to understand there's risks in investing in anything, but we're certainly intrigued by that consistency of historical performance.
So, and that even if the return was, let's say, 5% over the next 10 years and the volatility was almost zero, very limited, I'm sure it's not a huge amount of volatility in that. That lack of volatility basically, and maybe the counter-cyclical nature of that to some extent, can add a lot of value to a portfolio to reduce that the volatility in the overall portfolio and improve the risk-adjusted return. Tell us how you're providing like the ability for people to get access to that, through the app and the software, the website, that type of stuff.
Totally. So we talked about the why farmland. There's plenty more we can continue talking about, but lots of resources on our website as well at AcreTrader.com. But the how is fairly straightforward. Our team and both team of underwriting professionals as well as data science professionals have really deep understanding of the world of land. And so they find a whole bunch of properties, and occasionally one is interesting. And that moves through a very long process of underwriting, ultimately makes it to our website. And for the investor, what that means is rather than going and investing in $1 million piece of property and then, hey, congrats, you get to manage a farm. Like, it's a non-starter for most people we've ever met. You can go on our website and invest maybe $10,000 or $20,000 into a single property and get exposure. And then our team takes care of things from there in terms of management, payments, et cetera. And you as the investor can make money in 2 different ways, right? One is through rent or revenue share with the farmer. So some income each year. And then you can also make money through appreciation, right? So the actual underlying value of that land goes up over time. Those two things combined is what has produced that return of 11 or 12% here in the last 20, 30 years.
And that plot, let's just say you acquire a new big attractive plot that you've gone through all your research on, that plot, it's not like that plot enters a pool of many plots. It's that plot is a separate company, and then you get a portion of that company, or how does that explain how that works?
That's correct. So a plot of lands, let's take a $5 million farm and a winery in California. We have, as an example, that would go into a unique LLC. That LLC, then the investors that we call a special purpose vehicle, right, or a corporation entity. So the investors would invest in that entity. So the entity owns title and has the direct ownership of the land, has common documents to govern it, et cetera. And the investors own a portion of that.
And then what happens with it? Are you looking like Warren Buffett looks for companies where there's a guy, a man or woman who's running it and will probably run it for the next 20 years? Or are people selling this to you to exit what they're doing?
So the way we approach the market typically is with a farmer. So it's the secret of our business. We are farmer first. We have a broker dealer as well that allows us to work with that farmer so that they have real financial interest in most of these deals. So that is how we source, is rather than us going and knocking on the door of landowners, we knock on the door of the farmer and say, hey, you want to grow your business? We're like an equity finance partner to you. So we can go out and help you acquire land. And that farmer may not have $3 million to go buy a neighboring parcel, but he may have a little bit of money he wants to invest in that deal, and also can earn some financial incentives as well along the way. So it's a very unique and very powerful program and alignment of incentive between farmers and investors.
That's interesting, because if you're focusing, some people will imagine that you'd be focusing on just finding land and good land, and doesn't matter who's doing that. But the point that you're talking about is like, how do we find good farmers who want to expand what they're doing, provide them the capital needed to do that, and then let them get on with what they're doing. So in a sense, you're investing in an entrepreneur.
You got it. We're investing in business people, or investing alongside business people, I should say. Absolutely so.
I have one of my clients in Thailand. What they do is they bring their technology to landowners, and they basically say, we're going to grow corn on your land, and you just give us the biggest plot that you have. We've got our equipment, and it's within a certain catchment area, so that our equipment, we're going to be rotating around, and we're super efficient. We don't burn the crops. We don't leave any waste there. We pack it up all in bales. We use that in our own facility for biofuel and all that. So what they're looking for is kind of, a landowner that wants to continue to own the land, but that wants to generate more income out of it. Does that model exist in America, or how does it work in America for that?
Yeah, in many places, so about 40% of U.S. farmland is rented, right? So non-owner operated. So that's like $1 trillion of farmland. It's a very large amount where that is rented out. So and that's often just like the building that I sit in today. I here in downtown Fayetteville, Arkansas. I love the place that I work. I don't own the building. We have a business inside of the building, but we rent this building from somebody else that owns it.
One other question before I get into the big question of the podcast, because I just find it fascinating what you're doing. And you know a bit about Thailand, and we talked about that before we turned on the recorder. One of the things about Thailand that I could see is that what was happening was, and it happens in all the development of countries, where people move from farms to factories. And then we get basic infrastructure in place. And then all of a sudden you get a 10-year boom in an economy. It happened in Thailand. It happened in Vietnam. It's happened in China. Now China's growth is slowing. And now you got all these people in the factories. And all of a sudden you realize, whoa, we don't have many people to run these, farms and the family farms. In Thailand, it's almost all small scale farms. Could be 300 years that family's been farming that plot. And when I first came to Thailand, I was like, oh, this needs to be consolidated and it needs to be, bring commercial farming. And as I've gotten older, I've realized there's some downsides to commercial farming, whether it's related to efficiencies, related to chemicals, related to, that type of stuff. But when we had the pandemic reaction in the world where governments were shutting down companies, businesses, economies, one of the things that happened was that millions of Thai people in Bangkok flocked to the bus station, and they got on buses and they went back to their family plot. We don't have a social security system here. We don't have that kind of thing that's a safety net. But what they do have is their small little plot that they're barely hanging on to, and their grandpa and grandma or mother or fathers. And I now all of a sudden see that there is some value in helping farmers maintain, and farming families maintain their their plots. And I'm just curious, like you're in a much more advanced situation, of course, in America, but I'm just curious about your thoughts on that whole topic.
So we've seen that the folks moving out of rural America for 100+ years, right? With mechanization plus mechanization on the farm, and then urbanization trends in general. What's fascinating is the extreme majority, like extreme majority of farmland plots here are the same. They're family owned. They've been in families for generations, and we're like generally very happy about that, right? I think it's great to have. When we say business earlier, as an entrepreneur, as a farmer, that's usually a family business, right? Where they may have additional labor as well, or additional employees within the group, but it's often families, and that's a wonderful thing to be a part of, and for us to help. And that's who we work with, right? We're working with these types of folks to grow their business, and that's an exciting place for us, and an exciting value to bring to our little section of the economy, is that we can truly create win-win outcomes.
And these families are asset rich, and probably cash poor, in that they don't have a way to monetize or get any value out of the land that they have. And so I suspect there's some good opportunities for them then to upgrade what they're doing, and be able to get some cash to put their kids through school or what other things. So sounds like really exciting. So just remind us, where's the best place for people to go to learn more? I know you told me about your LinkedIn profile, which is one place, and I'll have a link to that in there, and remind everybody about the website that they should go to learn more.
Yeah, AcreTrader.com is our website. Pretty easy to find.
Yep.
And there's a ton of material on there.
And I'll have links to all that in the show notes. But now it's time to share your worst investment ever. And since no one goes into their worst investment thinking it will be, tell us a bit about the circumstance leading up to it, and then tell us your story.
So I spent about a dozen years in equity investing, both as a sell-side analyst and as a buy-side investor. And I worked at a fund that's about $1 billion of assets under management. I spent a good amount of my very, very concentrated, very deep dive investing. I spent a lot of my time on the short side, so betting against companies. And that can be a really painful part of your career, right? Generating alpha is hard. Generating absolute returns, dollar returns, is even harder when markets are going up. But it's an important part of many strategies to be able to hedge within your portfolio. So I had lots and lots of bad and really bad investments over the years. But one sticks out because there was a lesson learned there. So lots of folks will tell you about betting against frauds and how dangerous that is, because as an investor, you may have 10 or 20 stocks in your portfolio that you're shorting, you're betting against. The people running that fraud, they got one bet, and it's that fraud, and they can outlast you. And so as a general statement, we didn't chase a ton of frauds. We chased like okay businesses being valued as great businesses where the numbers were too high. There was one particular company. They were a healthcare software business. And I had a thesis, we as a company had a thesis around the macro developments, both cyclical and secular headwinds that this company faced. And the company is a fast growth software company, right? So to top off the fact that like, hey, there's these real pressures on their business that we don't think the rest of Wall Street is seeing, or the investment world is seeing. The stock is really expensive. The valuation is crazy, crazy high. So anyway, started digging into it. I started meeting with the company's CEO, and this guy was unbelievably impressive, like really, really good, and started like doing, the deep digging that we would do on the second and third level bench inside of the company, the people that work there and their culture. And it was like, all right, this is a really well run business, but hey, we still think these problems exist for their business as a whole. And so I then began to make, there were two, well, actually, I can stop and say, long story short, I lost most of the principal because the stock almost doubled on us before we covered, and it kept running. So lost most of the principal of that particular investment. And there were two primary learnings there, right? Number one is I felt myself, what was I looking for here? Gravitating towards that valuation argument. And valuation is not a thesis. Valuation is an important part of your work, right? And it can support an investment decision, but you never lead a conversation by saying this business, this stock is expensive or it's cheap. That is not a reason to invest. Stop, in the story, right? And again, it can be a supporting piece of information. It should be a part of your calculation in terms of position sizing, et cetera. However, in this case, I felt myself more and more leaning on that as it became part of my thesis. Oh, well, yeah. Maybe that stuff's not that great, but it's still really expensive. So number one is like a terrible flaw of letting that creep into the thesis. And the second was, don't bet against really good management teams. And then the inverse is true as well, right? Don't bet for really bad management teams, because they can absolutely and often do determine the outcome. And this guy kicked my butt and then some. They put up, despite all these pressures where we were, proud, right? He's like, oh, the operation was a success, but the patient died anyway, right? It's like the thesis ended up being good, but because of these two things, one, the street didn't care about valuation. There's a home run business. And two is this team executed so well. So be cautious in investing around management teams and around valuation. Those things can really be overlooked when making important investments.
And where is that? Is that company just continuing to roll, or did they hit any hard times over the years? Or
they've hit some hard times, certainly. I would say the stock is still probably 2x higher than it was where we initially invested. And it went up a whole lot after we covered. It's come back down some, but I'm rooting for them. Yeah. I'm cheering them on. I hope that they are super successful.
Yes, it's something about when a CEO kicks your ass that you think, okay, pretty good. Maybe I'll share a couple of quick things. I think I love what you said. Valuation is not a thesis, and I've actually never heard that before. And I teach valuation and been in the industry for a long time, so I really like that. I'm going to talk to my students on Friday about that. And but now, on the other hand, the valuation, as you said, can be supporting. So one of the companies I've been looking at and I've been talking to my students, and they're doing valuations of, is Toyota. Toyota is like getting hammered because they're not joining the EV bandwagon exactly the way everybody wants them to do. And they're getting a bad score on their ESG because they're exposed. Some of their factories could be exposed to floods. Thailand, the whole country, where they have a huge number of factories, the whole country was flooded in 2011. So, I see that the valuation now has been pushed down to 1x price to book, meaning you're getting all the future value basically pretty much for free. And it's a long history of it's the number one car company in the world, pretty much the most consistently profitable and well-run company. So betting against it, And so my question to you in that particular case, valuation feels like a thesis, but I think what you're saying is if there's not other fundamental things that are, driving that, then valuation is just going to be a tool. It's just going to be another input. How would you help us apply what you learned from that to, let's say, a situation like I've just described?
So I would suggest that valuation should inform your position size, right? Like, all right, you've got 100 theoretical dollars. Your maximum position size is $5. That price to book, price to earnings, EV to EBITDA, however you want to look at valuation, across a large spectrum of metrics and measurements, that should help you determine whether that, okay, you have a thesis, and then the valuation can determine, is my position size 0, 1, 2, 3, 4, 5, right? But that can help drive the sizing of the position anywhere from literally, I'm not going to do anything, I'm not going to invest, to I'm going to make it the biggest investment I've ever made. So the valuation can and should, in my opinion, influence your position size. But like, if you just tell me Toyota has a 1x book ratio, like, so what? Like, they could go destroy book value. Like, that book value could be cut in half in the next 3 years. I'm making this up, obviously. Like that's not a reason to invest or to not invest. Now, hey, I think they can double book value, or I think they can maintain book value, and we can capture additional future growth because of X, Y, and Z reasons. This becomes interesting.
Right.
Yeah, it is. We had like a rule of like, we discuss valuation of an investment at the end, right? Like, we're going to talk about the thesis and everything else, and then the last slide or slides in your 50 or 100-page investment deck can be about valuation, and because it informs how big we're going to go here. Do we want to go make a big investment, or a small investment, or none?
So let's go back in time and now think about a young person who is in your shoes now, and go back in time and look at it based upon what you learned from the story that you just told us and what you've continued to learn. What would be one action that you would recommend that listener of ours should take to avoid suffering the same fate?
I don't invest in single securities, right? Like I think like, as a professional doing it for 12 or 15 hours a day, okay, that's interesting. Maybe you can convince yourself you're smarter than the market. And then like maybe over a period of the next 5 or 10 years, you'll actually outperform the market. Otherwise, statistically speaking, it is unbelievably unlikely that you, Mr. or Mrs. Investor, over the next decade are going to beat the market by casually investing in single stocks, as an example. So I would always heavily encourage people to invest in ETFs. Then, if you want to go gamble, right, and you know that the odds are stacked against, like, people go to casinos all the time, and like they factually the odds are stacked against you, but they enjoy doing it. Okay, that's the same thing in public markets. If you enjoy researching and you enjoy the dig and you enjoy investing in individual securities, then like, and you know that the odds are stacked against you and you're going to underperform, like statistically, you're very likely to underperform the index. Go have fun, knock yourself out, have a good time. And if you really, really love it and you do that for a while, make it your career. Go all or none is sort of the way I would feel about investing in stocks and bonds, and probably most things in life. Like, don't be half committed to stuff.
It's great advice. So let me ask you, what's a resource that you'd recommend for our listeners?
For general investing, there's not enough reading you can do. Like, actually reading, if you want to be a good investor, like understanding what CFAs read is a good start. So the Schweser study books for CFA level 1, if you're already getting bored, this isn't for you. Don't like if you go read those books and you find them interesting, you should go invest more. It sounds like fun. If you don't tell me about, I bought McDonald's because it was $100 instead of $115. Like, that does nothing for either of us. So study, man. Like, if you like it, go study, and don't go study the heady stuff. Don't read heroics books about Warren. Like, you should still study Warren Buffett too. There's
Right.
a lot to learn there, but you're unlikely to be that kind of a hero. So don't fancy that you're going to be the next Warren Buffett unless you are willing to go study and learn a lot.
Carter, you're the first one to recommend buying the CFA study guides, like Schweser as an example. And I have a funny story about that. In 1995, when I was studying CFA, I was among a small group of people in Thailand that were doing that. And Mr. Swesher, the guy, I don't remember much, but I remember the guy came to Thailand and he arranged an event where he would do a weekend crash course for us like he did in the US. And there was about 4 people in that room. And I remember the last thing he said to us is, I'll never come back to Thailand, but it's really nice to meet all of you guys. And yeah, so, but definitely having been involved in CFA all of my career, past CFA in 2001, was a volunteer in our CFA society when we started in 2003, and rose to become a board member, a vice president, and then a 2-term president of the CFA society. Tonight, I have a course I'm teaching about CFA ethics. I just think that it's great advice. So if you're out there and you're thinking about, I really want to, I'm an engineer and I've been having some fun and all that, dig into that course material, because it really is the best contemporary, compendium of material that you should really know. And if you find that fascinating, then take level 1 and pass level 1. You may decide that that's all I need, and that's fine, but great advice. And that's very unique advice. Okay. Last question. What's your number 1 goal for the next 12 months?
I would have to break that into 2 parts,
Yep.
right? My number 1 goal as a person is to spend more time with my children, our children. So I'm too obsessive about work, and this rules my life. So yeah, that's the easy number 1 goal that I try to continuously optimize toward, is recognize my kids will hopefully I expect them to be in my life for the rest of my life. I do not believe that my current job will do the same. So when I'm 90, I don't think I'll be working at this company. Maybe I will be, but so optimizing towards family is an incredibly important goal of mine this next year.
Yeah, and I brought my mother to live with me when my father passed away about 7 years ago, and she's 85 years old. So we've spent 7 years of our lives together every single day. And neither of us expected that we would be in each other's lives to this extent to the end of our lives. But as you've just said, no matter, jobs come and go, businesses come and go, we make them successful, we sell them, we grow out of them, whatever. But if we can do right by our family throughout all the period of time, it means that all of our life, our family is a great component of it. So that's a great reminder for everybody listening and viewing. You're never, ever going to regret investment in family relationships. It's just something that I highly, highly encourage everybody. And Carter, I think you've given us a good reminder of that. So listeners, there you have it. Another story of loss to keep you winning. Remember, I'm on a mission to help 1 million people reduce risk in their lives. If you've not yet joined that mission, just go to myworstinvestmentever.com and join the free weekly Become a Better Investor newsletter to reduce risk in your life. As we conclude, Carter, I want to thank you again for joining our mission. And on behalf of A Stotts Academy, I hereby award you alumni status for turning your worst investment ever into your best teaching moment. Do you have any parting words for the audience?
This has been fantastic. I sincerely appreciate you, Andrew.
I appreciate having you on. And that's a wrap on another great story to help us create, grow, and protect our wealth. Fellow risk takers, let's celebrate that today we added 1 more person to our mission to help 1 million people reduce risk in their lives. This is your worst podcast host, Andrew Stotts, saying, I'll see you on the upside.